Good morning, everyone. My name is Margarita White with the Community Foundation of Noble County, and I'd like to welcome you. You are in our nonprofit leadership workshop series, which we are partnering with the DECO Foundation and Crossroads United Way. And today's session, or this quarter's sessions, are going to be over budgets and financials. And today specifically, we'll be talking about reading and understanding financials. We have a poll question that we want to start with today. So if you guys want to answer that question real quick. What is in your cup this morning? And it looks like most everybody has coffee. Nobody answered the other. Right? That's good for what, a Thursday morning. Okay, so I am going to turn it over to Brad Graydon, the Executive Director of the Community Foundation. So Brad, you are good to go. Oh, and before I let it over to him, I want to make sure if you have any questions and you want to ask your question directly to Brad, please unmute yourself and just say, hey, Brad, I have a question on that. You can also put your question in the chat and then we'll ask Brad that question for you. So Brad, take it over.
Good morning. I really appreciate seeing all of you this morning. As Margarita said, my name is Brad Graydon. I am the Executive Director of the Community Foundation of Noble County. This is kind of my third career, I would say. I'm so new to this facilitating business. I don't even have my own bio written up yet. So I'm gonna have to just talk through it myself. But I started out as a teacher. I taught at Central Noble Community Schools and for about 16 years. And then I was also an instructional coach at Central Noble and then at Huntington North High School. After that, I got into banking. I was a loan officer for one of our local community banks in Kendallville. And then that's where led me to my third career in the community foundation world. I am a lifelong resident of Noble County. I moved to Kendallville in 1972 and have never left. So Noble County is certainly near and dear to me, and I'm certainly excited to be able to work with Noble County organizations full time. I do have a little experience also in the nonprofit world. For 1 year, kind of a brief hiatus in my teaching career. I was the executive director of the Cole Center Family YMCA for 1 year, but really missed teaching and coaching. And so I went back into that, back to Central Noble once again. So that's just kind of a little bit about my background to share. As far as this series goes, this series is actually a team effort between myself and Tom Leedy of the DECO Foundation. Just due to scheduling, I'll be here today. Tom is not in the office today, but we are certainly excited about this opportunity to talk with all of you, and we certainly hope that you find the information that we share beneficial. So I'm going to try to do this properly now to share my screen. I was practicing, so we'll see if this works. I'll trust Margarita or Keith to give me the thumbs up that we're good to go. Excellent. So that is good to see. So as we said, Tom and I tried to put a little bit of an objective together for this overall series. We want to share that, this is a funder's point of view. We are certainly not financial specialists, but we want to help with financial management to elevate nonprofit leaders' capacity to understand and tell their organization's story through numbers. It is so important that not only is it to understand, but it also need to be important to be able to share. And so we hope that we'll be able to help you out with that process as you continue to participate in this workshop. One thing I do want to stress is that what we say is not gospel. Okay, this is not the only way to look at this information in terms of what type of information you're utilizing. To each organization, you guys are in charge of your own organizations, and you guys set the tone for how the type of information that you're going to collect and share. And we are also not here to try to solve any problems that might be happening on the financial side. Hopefully we can help you to better understand what is going on and diagnose the situation, but we certainly can't guarantee answers for those situations. So those are kind of my disclaimers as we get started here. As Margarita said, well, this is a 3-part workshop. We are going to be focusing on financial statements in this session. And then in August, you'll be looking at budgeting and also a concept called cash flow projections. And then lastly, in September, we'll be looking at sustainability, how to work forward from this information. So that'll be the series that we'll be working with. As far as today goes,
This is
as far as today goes, we're going to be talking about financial statements. We'll be working on a case study to hopefully try to apply the knowledge, and then looking at any last questions that you might have. I can't stress enough to ask questions as we go along. Please feel free to raise your hand, unmute yourselves, or ask a question in the chat, because it's going to be helpful to ask those extending questions while we're on topic. And it's also kind of a safety tool for me, because talking about financial statements, I can't guarantee that you'll be able to remember your question if you wait till the end, because if you fall asleep during this session, you may forget by the time we get to the end and ask questions. So please ask right away. Don't let it hold out. Tom and I did send out a survey to participants to try to get a feel for what you're wanting to find out. We had a good combination of staff members and volunteer leadership, such as board members or board presidents, share their thoughts. As it says here, you are trying to get a better understanding of how to explain financials to board members. I know that can be a challenge. I have been on both sides of the fence there as a board member and as the person trying to share the financials. So not all board members come in with the same level of knowledge to be working from. You also want to be able to show that you are being fiscally responsible. You want to show your board, and then your board knows that you are being responsible with the organization's assets, better understanding of budgets. And I did appreciate the use of the word decode a financial statement. I know for some of us, you may feel like you need a Rosetta Stone in order to be able to better understand what's going on there. But hopefully we can give you some thoughts and strategies on help with that process. One person on their survey did set the bar pretty high. They said, I will potentially use the recording with my board depending upon the information provided. And I kind of thought that meant depending on the quality of the information provided. So it did add a little pressure to the whole situation here. So hopefully I'm board worthy after this is all said and done. So, all right. So why are these so important? Well, from a funder's perspective, like a community foundation or a private foundation, funders are looking to make investments in items that promote the greater good. We want to invest in ideas that are going to lead to better results. And so many times we want to be able to see that trusting relationship. Now, funders aren't going to ask you to jump off a table and land backwards and hopefully the team will catch you like the gentleman is over there. But we do want to build that trust, and that's going to be based on transparency and accuracy. So it is important that it doesn't mean that your financials have to be glistening and showing amazing amounts of surplus. They just need to be accurate, because with any new nonprofit or any new programming, we as funders understand that those new ideas and initiatives take time to reach financial sustainability. We know that there are immediate financial concerns that need to be met, and that's what funders are there to try to help out with. But we need to understand what type of support is needed and how much support is needed. So with funders, it's building that relationship based on transparency and accuracy that's going to be so important in this process. As far as your board, we have some board members in here. Why are the financial statements so important to you? I'm going to build off of what David Nicole shared during his first 3 sessions of this leadership workshop. David did a great job, and I would encourage you to go back and look at those if you haven't yet. But he stressed the idea that the board members have a fiduciary duty. That's a pretty fancy term, but it is an important term. Board members have a legal responsibility for managing a nonprofit entity's assets. So there are legal responsibilities involved here. You have a duty of care, duty of loyalty, and duty of obedience. Much of the conversation we're going to have today is going to focus under the area of duty of care. David also highlighted a list of 10 responsibilities of board members. And so a lot of those apply to the financial side of things. Under effective organizational planning, a lot of times you might think of strategic planning there, but it's also budgeting. Budgeting is a financial plan for the organization moving forward. Ensure adequate resources, make sure they're managed effectively. And then, as it says there, accountability, maintaining the legal and ethical integrity of the organization. So it is important for board members to gain an understanding of the financials of the organization so that they can be confident that the nonprofit's assets are being accurately and efficiently managed. So board members have a big say in this also. So where does this good information come? It comes from good tools. Most common tools that you're going to be working with is a statement of financial position, also known as the balance sheet. And then on the income side, it'll most likely be a statement of activity, or some of you might use more along the lines of a comparative income statement. We shared our case study documents with you, so you'll be able to see examples of those as we go through this conversation. And then the annual audit is another financial tool, but this is a tool that not everybody is going to have. Depending on the size of your organization, you may or may not do an annual audit of your financials. So if you are not, there's nothing wrong with that. As we try to say, none of these are a one-size-fits-all solution. You're going to have financials that support your organization where you are at. The other tools are the budget, which is that annual financial plan, and also cash flow projections, which are looking at the cash that's going to be coming into and out of the organization over time. And we'll dig a lot deeper into, or we'll dig more deeply into the budget and the cash flow projection in the second session with Tom. So we're going to focus on those financial statements for today. So looking at this, you need to match your financial statements to your organization. And so the sophistication of them is based on the sophistication of your organization at the current point that it's in. And we're going to use what's called a life cycle process or a life cycle stage to try to help provide some information and a better understanding of what that means. So I'm going to talk about that. It's the life cycle that's going to help determine your financial system. So as I said, it's not one size fits all. You need to be able to convey information to yourself as the director, to your board, to your donors, if you have creditors, them, but it also maybe to the government, could be one of your stakeholders. For those of you, if your organization is large enough, you may have to file a 990 every year with the federal government. So that's another stakeholder that's going to determine what type of financials you need to provide. So to kind of talk a little bit more about the life cycle approach, just want to share, this is the book that I'm basing this information off of, called Nonprofit Life Cycles, Stage-Based Wisdom for Nonprofit Capacity. It's written by Dr. Susan Kenny Stevens. I can't recommend this book enough. It is a great resource that many of you may already have, but I can't encourage you enough to learn more about it. So in terms of the life cycle, I think a lot of you have probably seen the life cycle itself in terms of the 7 stages that are highlighted here, from idea building up to maturity, and then the decline, and then the option to either turn around the organization or it may go into the terminal stage. But if we focus on this life cycle in terms of finances, looking at the idea stage, this is that very early part of the organization. You may only have one employee, the director, okay? And you have a very small board at that point in time. Your whole goal at that time is to be attracting resources and making sure that you don't spend more than you have. And so, and this may be where your financial statements consist of your checkbook and your bank statements. You know, that's as deep as they get in that idea stage. And then as the startup stage, you begin to build up. You are going to have to start learning to manage cash flow to make sure that the cash is coming in when you need it to be coming in and then going out. And hopefully you're operating at least break even, you know, during that startup phase. Eventually then in the growth stage, you're going to be operating at a surplus level. If you're growing, you should have extra resources be coming in. And now you need to start thinking about where those resources need to go to. You also need to be looking at how can we start to diversify the income we have coming in, creating multiple revenue streams. Here is when you're going to start to see yourself starting to use those common financial statements like a balance sheet or an income statement, starting to track that information much more accurately and deeply. And so here, you know, you have additional monies coming in. So it's important that you and the board know what you have, know where it's coming from, what are our revenue sources, and then lastly, where is all of it going? So that is why in that growth stage, it's important that you're starting to develop some financial statements to help understand the process of what's going on there and understand where your growth is coming from. At the mature stage, this is where you start to build for longevity. You should be building your net asset balances. You should be working on that operating reserve, and hopefully you have those diverse funding streams created. Once again, you'll have those strong financial statements to back that up. Now, nothing is forever. You know, with all things, there is a cycle to this. And so most organizations, if they reach maturity and aren't constantly assessing the situation, they may fall into the decline stage. You know, nothing, as we said, nothing lasts forever. So it's important here during this stage that you're starting to match your current income back to your current expense. You know, it's kind of going back to that startup idea. We need to make sure we have money for this and money is available. Financial statements are important here because they can start to give you indicators or warning signs of troubles ahead. And so by looking at your financial statements, hopefully you can recognize this sooner rather than later and not have that head in the sand kind of mentality of, well, if I don't look, maybe it'll go away. You know, so that's where you need to have your financial statements to help you out there. Then the last two stages, at the turnaround stage, you have to get lean again. Okay, you're starting to understand that you need to get your expense levels back to their lowest amounts. And then I always thought this was a neat concept, this review budget versus cash. Okay, you have to go back. If you have employees at this time, you need them to understand that we can't spend things that aren't there. Just because it's in the budget doesn't mean that we have the money to pay for it. And so you need to make sure that you are spending money you have, not spending money you think you should have had. Kind of reminds me when I was a young kid, you know, all of us, I see some familiar faces and faces of my generation when the big deal was to get a checkbook. You know, nowadays it's debit cards and Venmo, but back in the day when you were young and you got your first checking account and you got a checkbook, I remember one friend who just kept writing checks because he said, hey, as long as I have checks, that must mean I have money. You know, but that's not the case. And with your budget, just because it's on the budget that it says we can spend this much on this program, if there's not cash to back it up, it's not there to help you out. So, and then lastly, in the terminal state, financial statements are still important here because you need to know what assets and liabilities you have with your organization, whether you're going to merge with somebody else or whether you are just going to close the doors. You need to have an accurate count of where things are at. So that's kind of where the financials here relate to the different life cycle stages. I would like to do another poll question here, Margarita, related to kind of, if you think about your own organization, where do you think you currently sit on the life cycle stage? And Margarita, I don't know if it was me or not. I couldn't see the results from the first one. So if you could, I don't know if you have to show it or not.
I'm not sure. Did anybody else see the results from the first one? Oh, sorry. Let's see if I can do this one correctly. They're still coming in. We have a couple more people to answer and then we are good to go. All righty, here we go.
Hey, there we go. So, well, what's exciting is nobody is classifying themselves as an other or in the turnaround phase. So that's certainly a positive. And we look at here, you know, almost 80% of us are either in the growth or maturity phase. So hopefully that means that most of you have some common financial statements that you are using in your organization. And those are hopefully what we're going to be talking about for you today. So that looks great. So as far as that life cycle book goes, the DECO Foundation is generous. They have a lot of copies of this particular book. So if any organization, any of you would like to have a copy of this book, the DECO Foundation is more than happy to provide that to you, either through the chat or later through email. Reach out to Sarah Larkin. Sarah is on the call with us today. So if you look for her name in the chat, under Sarah DECO Foundation, you can send her a chat message with your mailing address and they will get you a copy of that book. Just kind of in summary here, this quote by Peter Drucker, I'm going to guess looks pretty familiar to Sarah. This is one that Tom Leedy likes to reference quite a bit, but it's the idea that the nonprofit organization exists to bring about a change in individuals or in society. This is important to understand. Nonprofits have a mission. We have a focus and a charitable intent that we want to reach. So for us, nonprofits, money is not a means, or excuse me, money is a means, not an end. Money is a tool that we have in our toolbox to help us create our mission, help us meet our mission, but it's not the end all of our organization. In the for-profit sector, money is both a means and an end. So it's important that when we talk about these financial statements, it's not that we are money focused for the purpose of money. We want to make sure we have all the tools we have available to us in order to help our organization meet our mission. So just kind of want to make sure to share that and help provide that understanding. So getting in deeper here, then we're actually going to get into the financial statements now. The survey, the questions that we answered the questions of what are the types of money questions you ask or are being asked, and they're pretty similar for most organizations. You know, what are your operating and programming expenses? What are you spending the money on? This is a common one from the board to the director. How are we doing financially? You know, what's the current state? How do I read statements to pick up what I need to know quickly? The way I interpreted this question is that as I look through my financial statements, what are some initial things I can go to that help me get a quick understanding of where we are financially? So I hope that's what people are talking about. And from a donor's perspective, they are going to be asking questions like, where does your organization need the support the most? And so you need to be able to answer that question and have an understanding of financials. One other question that maybe you haven't had to ask yet or answer yet, but think about this. What would your organization do if you got a $50,000 unrestricted gift next week? What would be our plan? Well, this is why your financials are important, because this can help you decide where this should go. And this is also important to understand where you are in your life cycle stages, because that can impact that type of answer too. So we'll kind of circle back to this question in a little bit. But right now I want to go into the different financial statements here. Once again, please don't hesitate to stop and ask questions. As we dig into these specific financial statements, things may pop up, extending questions may come into your mind. Please ask them right away. I'm going to try to hit on the general things associated with each one of things, but if you have a deeper question you'd like to know more about, please don't hesitate to ask it. So the first statement is that statement of financial position. In the for-profit world, they call it the balance sheet. This is the net worth of the organization. So this is the idea of, do we have a positive net worth or a negative net worth? So this is relating your assets of your organizations with your liabilities. Some key pieces of information, asking that question, where should I look first to find quickly how my organizations are doing? Well, first thing to look is your cash. Do we have cash in our accounts? And that is listed right there under the current assets. The first line is cash. Also shows your fixed assets. Some of your organizations may rent, so you don't have a building that's listed there, but that's where you should have. If you own equipment, that'll most likely be listed under your fixed assets. And also then the depreciation associated with it. I would also encourage you, I couldn't put the whole financial statement on this page and have it look very clear. So don't forget, you should have case study documents already provided to you that will show you the entire financial position statement on one piece of paper. So I would encourage you to keep those handy as we're going through this. So we talked about then your debt is going to be listed down under your liabilities. Another thing you're going to see with nonprofits, most nonprofits are probably dealing with equity or that are either considered temporarily restricted or unrestricted. With temporarily restricted, those are items that are being given for a specific purpose. And so they are not free to be used by the organization under their own direction. These have specific restrictions that are placed with them. So questions you can answer with this statement is, do we have a positive net worth? Are we in a positive position? Do we have cash? How much debt do we have? These are all the pieces of information that you can get from your statement of financial position. So that is, that's kind of an overview of that. Any questions related to that? That one's probably the more straightforward of the two that we're going to focus on today. The statement of activity. This is a statement that some of you may or may not get on a monthly basis. This one's this one expresses the organization's activities in revenues and expense for a given period of time. So unlike the statement of financial position, which is as of a specific date in the year, one day, June 30th, 2021, this is for a period of time. So for us, this one's for the first 6 months ending June 30th. So this means that this is the first half of the year. This is how we are doing on a revenue and expense side. With the statement of activity, you're going to most likely see an unrestricted column, a temporarily restricted column, and a total column. So they are this is exactly what you would see in most of your annual audits. If you have audit paperwork done, you will see this type of statement of activity. This is not always the easiest thing to understand. That temporarily restricted column can always be a little bit confusing. So it's important that you look at those different things. Something I want to highlight here is that there are no temporarily restricted expenses. So if you're looking at the entire case study sheet, you'll see that all the expenses are listed under the unrestricted side. You'll notice on the temporarily restricted, there's a $75,000 that have been deducted. So what happens is, in terms of accounting, when the purpose of those funds is met. So let's say those funds were geared towards a specific program or project. That project took place, it got expensed out. That means that those restrictions have been met. And so those funds go from being restricted to unrestricted, so that then they'll be spent. So you'll notice that there's a matching number there between the temporarily restricted going down by 70,000, 5,000, and the assets coming up to 75,000. So like I said, I'm trying to not get too deep in the woods here with this, but that's common. One of the more common things you'll see on this particular statement. Many of you might be more familiar in what's called the comparative income statement. And this is the type of income statement that provides you with your actual expenses and revenues for the month, how much was budgeted for each one of those items, and then the difference or variance between them. So that is another one that's done with that. So big types of information you're going to get here is surplus or deficit. I don't want to talk about profit and loss here because remember, money is not the end goal of a nonprofit, but we need to know if we have a surplus or a deficit of resources, and that's what will come out of our statement of activity or our comparative income statement. That's probably the most important question that you are going to have here. The other thing that's really important on your statements here in terms of revenue and expenses is to make sure, as one of the common questions is, what are our operating and program expenses? Well, if you have programs that you run that are specific to your organization, it is important that the revenues and fees associated with that program are listed as line items on your statement of activity or income statement. You need to make sure that that's broken out so that you have easy access to the information associated with it. Because if you have 2 or 3 programs and they're all very important to your organization, I would encourage you to break those apart on your statement so you know how each one is doing, not just kind of overall. Once again, though, it is your organization. You can run it how you see is best fit between you and your board, but those are just some of the tips that I would have related to that. Thoughts or questions there? Okay. Next, as far as the overview of the budget, not going to dig deeply into this. As I said, this will be more of a focus of session 2, but the budget is very, very important in terms of planning. It frames your organization's big picture, and it helps them to frame your cash flows. Your budget, if you look at our budget, it is not a balanced budget. This is something that is a conversation between you and your board, whether you want to have a zero-based budget or not. That is each organization's decision. And Tom will talk a lot more about that in the next session. But the budget is just your planning for the year. And then one thing that comes out of that is your cash flow statement or cash flow projections. This is you anticipating when the money is coming in and when the money is going to be going out of your organization. This is kind of a next level statement, and that's why it's the last one listed here. This one's really breaking things down for your organization. And so this is most likely something that something in the initial stage or even the startup stage, startup or even growth stage might not be to this point yet. So, but this is something else that Tom will dig deeper into in session 2. So we're not going to touch on that too much. One other accounting thing I want to talk about, because you may be asked this question, whether it's by your own board or it may be by outside funders or outside stakeholders, is the accounting method that your organization uses. There are 3 of them that are generally recognized. First of all, there's cash accounting, and this one's very explicit to you don't record anything on your financials until cash changes hands. So until a payment is made is when it gets recorded into your financials. So that's the basis of cash accounting. Accrual accounting is accounting that is based on the transaction taking place. So let's say you purchase something on invoice, you don't pay cash immediately, but you might recognize that expense on your income statement or your statement of activity when the transaction happens. At that point in time, there would be an accounts payable item listed. Okay, and it hits your statement of financial position at that point in time. So accrual accounting, your financial statements are going to have categories on them such as accounts receivable, accounts payable, prepaid expenses, items like that. So those are some examples of prepaid expenses might be like insurance. You pay for the whole year, but it actually doesn't get expensed out. It gets expensed out monthly on your statement of activity. So those are things that are basis of accrual accounting. And then lastly, there's modified cash basis. This is a combination of the two. Basically, you're taking elements of each type of accounting, cash or accrual, and matching them up to help set whatever shares the message of your organization best. So that would be the modified cash basis. So there's no right or wrong way to do it. These are just the categories that it falls under. Just trying to share that information there. Thoughts, questions? I'm always scared as people go off the screen that nap time's starting to kick in there. So we'll see if we get everybody back at the end, Margarita. All right. So looking at the case study here, another disclaimer, because when you do these type of presentations, you're always concerned about pulling stuff off the internet, or nobody really wants to put their financial statements out on the screen. And so Tom and I did our best to make up our own financial statements. That means we were the ones making up all the numbers too. So those of you with strong accounting backgrounds and you see some things that don't line up, that may have happened. We tried to fix as many things so that they lined up properly, but not to say this is a disclaimer to say that we didn't want to get in trouble for copyright infringement or sharing any of people's business. So we tried our best on these case studies. So looking at the first thing here, the statement of financial position, what I want to do is highlight and ask you guys some questions. So those of you that unmute yourselves to answer this, if you don't mind, would be great. But here's kind of the questions I want to see here. First of all, what type of accounting method is this organization utilizing? Neil, I saw you unmute. You want to
it's an accrual statement.
Okay. What jumps out at you to cause that?
Well, the accounts receivable, prepaid expenses. That makes it kind of obvious.
You are correct. Now, it is a little bit of a trick question because it also could be the modified cash basis accounting, because they may have chosen to use that combination of things. So, but you're exactly right. Accounts receivable, prepaid expenses. Also, if you're looking at the full statement, the accounts payable down there is going to cause that to show up as accrual accounting. If you did want to know what your organization is doing, if you like, well, I don't know which one. I think we have accounts receivable, accounts payable, but I don't know if we're accrual or modified cash. If your organization is large enough to fill out a 990, you have to declare that on your 990. You have to declare what type of accounting system you are using. So board members or staff, if you want to know that question and you have a 990, you can find it there. So that's that question. All right. So what's the difference between cash and accounts receivable?
Please feel free to unmute yourself and answer Brad's questions. We have a few more of these in the presentation, so.
The cash is what you have in hand, and accounts receivable is what you may pick up later.
Yeah, and you're exactly right. That is to become cash in the future, is your accounts receivable. You have invoiced somebody and you are expecting them to make payments. Hopefully it will be cash and not maybe cash, because accounts receivable is important that you're collecting all the money that you are due. And this is what's important to understand in terms of your financial statements. They have accounts receivable at $28,000. So that means that the organization recorded over $28,000 worth of revenue on their income statement, but they don't actually have the cash yet to back it up. So it's important as you're looking at that, you may say, well, we're showing positive surplus, but why don't we have any cash in the bank? Well, it may be because it hasn't been collected yet. So it is important that you understand that. How about then the difference between current and non-current assets? or liabilities. It's the same rule for both.
Basically, you're looking at the current liabilities or assets to be turned over soon.
Right.
Usually within a year, but often very much sooner.
Very good, Neil. Yep, it's that 12-month cutoff. We expect anything under the current assets to be coming into cash within the next 12 months, whereas your other non-current would be considered over 12 months.
Random question, but what would the other be?
Oh, under your assets,
Yes.
that's kind of that catch-all category, because we also don't want our financial statements to be so long that you can't understand them. So other or miscellaneous is a common catch-all type of asset. This could be, oh, that's a wonderful question. It can make me give you an actual example on screen here. Trying to think of the best example of other assets. It could be some of your inventories, like in terms of a nonprofit world, it's a little bit tougher, but in some organizations, their inventories are not, they separate between finished products and products in production, so they may keep that in other, but it's just kind of a catch-all is what it is. That's a great question, Lisa.
Thank you.
I wish I had a much better answer for you. Looking at the next one then here, looking on the liability side, we kind of hit this, and Neil, you kind of touched on this already, so I'm going to ask my extension question. The difference between current leases and equipment leases, you see that you have under current, we have equipment lease current, and under long-term, we have equipment leases. So that means that in the current year, in this current period, in the next 12 months, we're going to owe a little over $6,200 in lease payments. So if I were to say to you, we only have one lease out there that we're making payments on, can you tell me approximately how many more years we need to make payments on this lease?
Probably 5 after the one you're in would be my guess.
That's perfect, Lisa. You're exactly right. So she looked down there and saw that our equipment leases are long-term, which means over more than 12 months out, we still had $30,000 remaining. So if we're paying $6,000 a year, it's going to take 5 more years to pay off that lease. This becomes important too if you're looking at, this is the same principle as if you own a building and you have a mortgage on it. You're going to have your mortgage, you'll have your current mortgage payments listed, which show what you're going to have to pay over the next 12 months on your mortgage. And then you'll have whatever's remaining on the mortgage listed under the long-term portion. So for those of you board members wanting to know how much you have in debt and how much longer it's going to be there, this is a way that you can tell that. So next question here is kind of based on, you can cheat if you have your handout out, but this was kind of meant if you're looking off the screen, what are the total assets of Education Inc.? Well, maybe because it's too obvious, but basically, if you remember your assets, this is called a balance statement, which means that if you look at it, think of it as the old-fashioned scales, where you put weights on one side and the object on the other to find the weight, you had to find the balance point. In this case, with our assets here, our assets have to balance with our liabilities and our equity. And so if you look at the bottom of the sheet, it says that the total liabilities and equity is equal to $139,767. That also means that our assets would then equal $139,767. Any other questions related to the statement of financial position? Okay. As I said, there are 2 ways to look at the income side of things. We talked a little bit about the statement of activity. I would like to focus more now on the comparative income statement. I'm going to guess this is probably more familiar to most of you if you're working with an income statement with your organization. This is the one that's going to have your actual column, your budget column, and then the variance. So if you have that one handy, that is kind of what we're going to be talking about here. So get to the questions on the comparative income statement. This one provides insight into the day-to-day operations of your organization. This is that operating statement. How are we doing as an organization? By comparing our actual to our budget, that helps give us a diagnostic tool for our organization to help understand what is going on. And don't think of diagnostic as always negative. Diagnostic is merely trying to understand what's going on. We may have a huge surplus on our income statement. We probably ought to understand where it's coming from. You know, is that a sustainable surplus or is that a one-time deal? So to ask some questions here, I want to look at the variance columns here. And could anybody, if you look, we have some significant variances in the areas of tuition under revenue, and then under faculty fees and text and materials under the expenses. Can anybody think of a reason why that could be, or help explain the purpose of those variances?
Did
Brad,
anyone see?
okay, Brad, you're looking at June, which is a little, I don't know exactly what Education Inc. does, but if they're looking at some sort of a school year sort of realm, then, you know, tuition, that may bump up and balance out when it comes to August or September or whenever they're collecting those tuitions, text materials, all of that stuff. Staff development, let me look down to staff development. They may be in their training sessions because they are not in the classroom. So this is a time when they would spend more, but it would balance out later, maybe at less, because they're not doing that right now, or later on, rather, sorry.
Nope. Those are plausible explanations. Any other plausible explanations? There's certainly no one correct answer here. Well, one more I'll share. Perfect comment on Angie's part in terms of timing of funds coming in and coming out. That's a great observation. Another one that I thought of, you know, tuition's we're below budget by $5,000. That means we're behind budget in terms of tuition. So not as many people are taking our classes or paying tuition. Well, if not as many people are coming in there, if we only have to pay for stuff as we use it, well, that could be an explanation then of why we haven't needed as much faculty as we normally need, and we haven't needed as many textbooks and materials as we normally need. So being down in tuition, at least what helps in this is that it's offset by less expenses. So there is an explanation there. Staff development one, this is one we saw in our own organization, my own organization, the Community Foundation, especially if you looked at 2020, you know, you made this budget in 2019 with the idea that we're going to go to all these conferences and everything else in 2020, and it never happened. And so, you know, that could be one reason, is that staff development, you wanted to do it, but you just couldn't because it wasn't there. So when you have those type of variances, it's important to understand that you recognize the variance, you need to be able to explain the reason for the variance. So this is where you can tell your organization whether you're ahead of budget or behind budget as you're looking through this information. What can be kind of confusing too is that the behind budget is parentheses, those are negative, ahead of budget is a positive number. So you can see, you know, so if you look just at the top of this, you would say, wow, this organization's almost $26,000 behind their budgeted revenue. They must be hurting. They must be at a deficit level. If you look down at the bottom though, they are actually over $35,000 ahead on the expense side. And so really they are still showing a surplus of $9,300 for the first 6 months of the year. So you got to make sure to look at the whole picture as you're going through this information. The other thing I want to mention is that some variances may be due to timing. Most organizations, and they keep it simplified when they're creating the budget column on their income statement. And they say, we know on our budget, this is how much we're going to spend for the entire year for staff development. But on our statement, we're just going to simply divide it by 12 and note that this is how much we're going to spend each month on our statement. So for staff development, the overall budget was for $10,000 for the year. So as of 6 months, they should have spent $5,000 there. It could all be timing in the sense that for Education Inc., their huge staff development time is during the last 6 months. And they're going to end up, they have a big workshop they travel to, or it's $1,000 a person. They're going to spend $5,000 in September. So they're ahead of budget now, but just due to timing. It's not because they haven't spent money they were anticipating. So you just got to remember there's some expenses that you incur. It could be vice versa. Their staff development could have been in March and they spend 8,000 of the 10 in March. And so they're behind budget the entire year until the end of the year. So you can, if you want to take the time to plan your expenses, you can help that match up better budget wise. But most of all, it's just understanding it's a timing thing. And it's important for you as directors and staff members to share that with your board, help them to understand what's going on. I know with my board, they look at the variances right away, and the ones with the biggest variances, that's the one they want to understand, they want to know more about. And so as you're looking through there, that's what you need to be able to explain to your board, why those, what are the bigger variances being caused by? 9 times out of 10, it's a very logical reason.
Brad, I have a question.
Yeah, Sean.
So is there like a rule of thumb for percentage when you need to explain the variance? So like if it's a certain percent, like, yeah, we should give more explanation on this. I only ask it because I have a funder who like, they want to know like every single variance, like every single reason why. And, you know, and a lot happens in a year and I have to recall, you know, like, gosh, why did we spend $5 more? So I don't know if there's like a rule of thumb.
You're touching on 2 great things. First of all, no matter whatever the rule of thumb is, it's your funder that's going to determine what their rule of thumb is.
Very true.
Is that in that case there? In my experience, generally speaking, if you're dealing with a percentage, usually if it's something less than, you know, so what Sean's explaining there is our cash flow statement shows a dollar variance, but it can also give a budget variance so that if you budgeted $2,000 and you spent $4,000, it's going to have a variance of 200%. You know, you spent twice as much. So with me, for me personally, anytime it's over 110%, I'm probably going to do a little research as to why it's that way. We have, you know, we have variances that are much higher than that, but it's mostly due to a timing issue. It's a large expense at the front of the year. And as I tell them, it's going to smooth out as the year goes along. So rule of thumb and it's also, you got to understand too, I have one line item that shows it's 200% over budget, but it's the whole budget line is only $300. You know, so it's like, you know, it's not quite as a significant issue, and it's all timing because it's something we pay at the beginning of the year that is expensed out over the entire year. So that's my rule of thumb. But you know, those are the kind that jump out at you when they're over 110, 120% over budget. But your funder, they may be that anytime it's 101, you know, I guess think of your speed limit rule. 909, you're fine, 10, you're mine. Isn't that what the state police mantra is or something like that? You know, could be the same way with your budget variances. That's a great question though, Sean.
Brad, can I make a comment?
You bet, Neil.
This budget column shows, you know, the 6 months budget. So you're comparing 6 months versus 6 months, but I find it's been helpful when I prepare one of these statements to have a column that shows the total budget for the year as well, so that people can see that, you know, you might be over budget now, but you're not even close to meeting your total budget for the year in that particular area. And they can see that you're not really over budget, it's just timing.
And Brad, if I could jump on the back of that statement from Neil. This is how, as an executive director, I use the year long, as Neil was talking about there. And I look each month, when I look at those figures, I know, like, if I'm in June, I should be seeing 50% on everything. If something's way off, that's where I go to right away. And then I know when I get to that quarterly mark and I'm going to give a report to our board, that's where I do the budget narrative. So those percentages based on to the as applied to an annual amount that's really what drives my reporting to the board, so that they can see, hey, we're right on track, or and if I'm within 5%, I'm happy, especially on revenue. If I'm 3 to 5%, and I know that we're running in a good place if we can stay within those percentages. It makes it an easy, quick way to look.
Those are great comments. Neil, your point is well received. And it's that whole idea of setting up your financial statements to the way that your organization wants to tell their story. And Angie, you hit on the point of, if you do it by the whole year's budget and your percentage based on the whole year, that'll help. And that may help you, Sean, in the sense of, if it's just a timing issue, it won't show that the variance has been blown 6 months into the year, because it's still going to be below 100% and it wouldn't stick out quite as much. So that helps with the timing discussion. If you're showing your whole budget amount on that same statement, it can help with that too. So those are great comments. Any other questions there related to, or comments related to that income statement? Okay. Kind of the last thing just to kind of share here is talking a little bit about, what story do people want to hear? And so Tom and I just tried to put a little grid together here that kind of shares what maybe the different types of questions that these people are going to be talking to you about. With your board of directors, we talk about their fiduciary responsibility. They want to know if your organization is a going concern. Another accounting term, just wanted to use it in case maybe you've heard that in conversations in other places. But I defined it at the bottom there. The simple definition of a going concern is that you're going to stay in business for the foreseeable future. If things stay the way they are, you are good to go. But that's kind of a business term that some people might share. As far as your directors and your managers, they want to know, for the next week, can we make payroll? Can we do things like that? That's that current issue. Future issue is resource availability. Do we think that we're going to have funding in the future to be able to continue to move forward with what we're doing? An example of what that might look for there is your accounts receivable on your balance sheet or your statement of financial position. Your receivables are showing you anticipated cash coming forward. So that could be a source of resources moving forward. Your staff members, if they're associated with a particular program, they want to know that program is going to continue going forward. That's both now and in the future. And maybe there's a chance for it to expand in the future. Question there at the bottom, should programs that operate at a loss be discontinued? That's an organizational decision. But just want to share kind of my experience and some of the nonprofits that I've served on with boards. We've had the organization I work for, we've taken on new programs that we know are going to operate at a loss, but they're part of our mission. They're part of our charitable intent. And so we need to meet that need. Now, doesn't mean you always just handle it that way. Well, there's other things you can do to help support it. Maybe that's where you got to go out and fundraise for that program. You have to, the revenues from the program don't get it done. You're going to have to find additional fundraising to do it. Or maybe you already have other established programs that run at a surplus that you can utilize those additional resources to help offset the deficit that's in this startup program. So that is how this organization that I worked with approached that. So just kind of wanted to share that thought with you. And anybody else has comments related to that, please share.
I just put this in the chat, but that's sort of how our furniture ministry works. It was so tied up with Common Grace for so long that it doesn't really have its own donor base, but we've encouraged our donors to provide unrestricted funding so that we can use it where it's most needed. And we have a policy of each quarter looking at that and using those unrestricted funds to zero balance those projects or those programs when we need to. And the accountant knows that, it's the quarter, we're going to look at that, we're going to make that adjusting entry and use those unrestricted funds. So it just all happens very smoothly now.
I think you do have to be cautious and really gauge that longevity of operating at a loss, because then where's the sustainability? So being able to measure both of those, there's a lot. That's the challenge. Sometimes we don't want to kill programs because we want to help people. But at the end of the day, we still have to be responsible for the organization and the growth. And so that's a fine, there has to be a lot of balancing, and I would hope a lot of strategic conversations in the mix, because again, it goes back to, the quote, it's not just about the money, there's other resources to help make things move. And whether that's just getting strategic in the volunteering side of things to help reduce costs and staffing, there's all kinds of things you can do, but just always measuring that loss with sustainability as well.
That's a wonderful segue there, Sean, to this other grid. And this is talking about your external conversations with funders, donors, and creditors. That future conversation is going to be related to sustainability, whether it's for a specific program or for your organization as a whole. And sustainability, the way we're viewing it is that, does that program have reliable sources of revenue to cover operational expenses? That is what sustainable would be, is that it can survive on its own. And so well-received comments there, Sean, and greatly appreciate them. The creditors line there, they're going to be not only worried about current, but their future payment is can we get paid in the future? So those are the storytelling you need to be able to tell them that will happen. And as Sean mentioned with hers, that's why it's so important to have clear, accurate financial statements to work from. So that you can try to help understand, why is this program continuing to go at a loss level? You need to be able to explain that. And it also helps you to explain that, well, hey, if we can use volunteers instead of paid staff members for this program, here's how much we'll save on the expense side. And here's then how we can improve the sustainability of it moving forward. So that's so important in this process. Just kind of covering just some warning signs here. All of these are pretty straightforward. I think one of the more common ones is that middle one there: lack of money is the dominant conversation and leadership doesn't know where to start. That is a big warning sign of some financial troubles working forward there. So that's why, lastly here, talking about how to make good decisions. Well, sound fiscal management results in predictability, which tames the fear of the unknown or risk. Understanding where your finances are at helps you to anticipate what is moving forward. And that anticipation conversation is really going to become big in our next session when we talk about budgeting and we talk about cash flow projections. So I know I've kind of hit my time frame, and I apologize for that. Here's the contact information for myself and for Tom, and would be happy to answer any additional questions or a wrap up that Margarita has.
Thank you, Brad. And I'm sorry that we have gone just a few minutes over, but I just wanted to remind you, the next session is August 12th. And it's going to be talking about developing your annual budgets. You will get the recording either later today or tomorrow, along with a survey about this session. And then next week, you will get a different survey, and that survey is going to be about 2022. What kind of things do you guys want to see in our sessions? Do you want to continue doing these as a webinar on Zoom, or do you want to go back in person, things like that? So be looking for that next week. Does anybody have any other questions for Brad before we finish today? If not, I want to thank Brad for all that he's shared with us, and we look forward to seeing you all on the August 12th session. Thank you.